Hello, I'm Victoria and welcome to our Chapter 9 tutoring session for Principles of Accounting 1. Like I said, today we're going to be talking about Chapter 9, okay, and what Chapter 9 is dealing with is long-term assets, okay, so I'm assuming you've already read the chapter. So first of all, I'm just going to start off talking about some large concepts that you should have gotten a grasp on after you read the chapter. So one thing you should know how to do now is record the purchase of a fixed asset, okay? A fixed asset is something, like I said, that is a long-term asset, okay? So if we were going to talk about a building, okay, you need to know what expenditures are included in the cost, okay? So if you were going to journalize a building, okay, everything included in the cost is whatever gets the building ready to be used, okay? So let's say we bought a building and we had to redo the parking lot, okay? Redoing the parking lot is going to go into the cost of what the building was, okay? Same thing if you had to redo the landscaping, okay? It's everything that gets the building ready to use for your company, for your use, okay? The next thing you need to know how to do is compute and record depreciation at the end of the accounting period using the straight line, double declining balance, and units of activity methods, okay? You'll also need to be able to compute partial year depreciation for the year of purchase and the year of sale of the long-term asset, okay? So a lot of people have a difficult time understanding what depreciation is, okay? So I have a definition here that I'm going to read to you, okay? Depreciation is allocating cost of a plant asset to expense over the estimated useful life of the asset, okay? So it's not like something we have like supplies, okay? When you use supplies, it actually goes away, okay? When you use a building, okay, the building doesn't go away, okay? But let's say you buy a building, okay? What you paid for it on the very first day is not going to be how much it will sell for 30 years down the road, okay? So you have to take into account years that have gone by in use of the long-term asset, okay? So I hope that makes sense. Keep going. You'll need to know how to compute revised annual depreciation, okay? And we'll look at that in the problem that we do in our next video. But you'll need to be able to know how to calculate a new book value if things change according to the long-term asset in any of its life, okay? You'll need to know how to classify expenditures made during an asset's life, okay? And those are listed on page 460 of your textbook, so know how to do that. You'll need to know how to record the disposal or sale of a fixed asset, including any gain or loss. Okay, so your steps for that would be update your depreciation, which we'll look at later. You'll need to remove the asset remove the asset and accumulated depreciation whenever you sell it, okay? And then you compare the proceeds to book value to compare whether or not you got a gain or a loss on disposal of the plant asset, okay? And then you'll just need to have a general idea of how to record and amortize intangible assets, okay? Intangible assets could be anything from copyrights, patents, trademarks, I guess, stuff like that, okay? So those are the general things you should be able to know from Chapter 9, okay? And like we said, just going through some of the concepts you should have grasped again. A long-term asset has a use over 1 year, okay? It has physical substance, okay? It's used in operation, and it's not for resale, okay? So when you buy inventory, you eventually are going to sell it for profit, okay? But if you buy a building, I mean, I don't even know if real estate does. I'm not a finance person, but I don't know if they, in real estate, you know, some people you see on TV, they do some of the things where they buy a building and fix it up and sell it again, but most businesses don't do that. So if you buy a building, it's going to be used in the operation of the business, and you're not going to immediately resell it, okay? Cost of a long-term fixed plant asset includes all expenditures to get the asset ready to use. So more examples than what I just said are the price, tax, shipping, installation, insurance during shipment, tearing down the old item, parking, landscaping. If you bought a truck or something like that, you have to paint slogans and your own logos on it, signs, and then, like I just mentioned, real estate, the commission due to the real estate agents that help you buy or sell the property, and then attorney fees to get the deed signed over and all of that stuff, okay? And so the next thing you'll need to know is a formula that is book value is equal to cost minus accumulated depreciation, okay? Book value is what changes when you figure out how much depreciation you're changing every year, okay? So if I had an item that I bought for $1,000, okay, and over 1 year, $100 of that 1,000 I distributed as depreciation, okay? At the time of the second year, my book value would be $900, okay? And if we were continuing on with the straight line method, the next year, if it was another 100, my book value would be 800, and so on and so forth, okay? So at the very end of calculating your accumulated depreciation, you want to have your book value at what they call salvage value, okay? And salvage value is what you expect to sell the fixed asset for whenever you're done with it, okay? So you never want to let your book value go below the salvage value, okay? So just keep that in mind. We'll do a problem, so if this is kind of confusing, maybe with an actual problem it'll make a little bit more sense later on, okay? And like I said, there are 3 ways to compute depreciation that we're going to look at are the straight line method. And with the straight line method, every year is the same amount of depreciation expense, okay? So we'll look at this in a problem, but you'll take, you'll take the cost, okay, and you'll subtract the salvage value. And we know salvage value is what you think you'll get for the asset when you're done with it, okay? And then you will multiply that by 1 over however many years you think you'll be using that item, okay? And then that amount is what you will put in depreciation expense and add to accumulated depreciation every year, okay? That's the straight line method, okay? Another one we're going to look at is the double declining balance, okay? And what that is it's the same type method as the straight line, except what it is you do the depreciable cost is equal to cost, so that you don't take into salvage value for double declining balance, okay? And instead of just doing that cost multiplied by 1 over how many years you think you're going to use it, you do that multiplied by 2, okay? So the idea with double declining balance is that you are doubling your depreciation expense from what the straight line method had, okay? And for double declining balance, as always, you never want your book value to go below salvage value, okay? The next one we're going to look at, and the last one we're going to look at, is units of activity. Okay, so this one is a little bit more catered to specific examples, okay? So one of them that I have just looking at here is, let's say that you have a truck, okay? Every year you will estimate the unit of activity you think the truck will do, okay? And for a truck, it could be how many miles you think the truck will drive until you're done using it, okay? Or you could have a piece of equipment, how many hours you think it'll run in a year or something like that. And for this one, looking at the depreciation, for each year you'll be given the amount of activity they think it will be in the units of miles, hours, something like that, okay? So for just the truck example, let's say in 1 year you think you're going to drive it 24,000 miles, okay? It will give you that, okay? And then you have to calculate the rate per mile, okay? The rate per mile is equal to the cost of the truck minus the salvage value of the truck, okay, divided by a total expected miles, okay? So it would come out to be something like 50 cents a mile or something like that, okay? So your depreciation in that sense would be the amount of miles you think you'll drive in 1 year, okay, multiplied by the depreciation rate per mile, okay? And what that does is that gives you the total depreciation cost not per se, that's what it is, the total depreciation cost for the year. And the thing about that one is every year it changes, okay, but you don't have to necessarily worry about adjusting for a partial year. So if you bought the truck in the middle of the year, you wouldn't have to do a revision on it like you would for double declining or straight line. Okay, so that's just talking through a little bit of what you should have grasped. Okay, and just understanding how depreciation works, and later how to dispose of an asset. Okay, so I believe in the next video I'll be doing an example of the straight line, double declining, and units of activity method. We'll be doing that in an exercise, so I hope that was helpful. And if any of this was confusing, again, feel free to post a question in the discussion board. And then I'll make another video if it needs to be a little bit more detailed. And as always, if you have a question, go back to your textbook because it's full of information. So I hope that was helpful, and we'll see you next time.